Hello, everybody, and welcome to this week's edition of Your Mortgage Process. I, of course, am your host, Greg Wareham. We got a great guest today, and you know what? It's the perfect time to have Dennis Kilfeather on the show. Dennis, how you doing?
Greg, thanks for having me here. Excited to be here.
It's great to have you. It's tax season, baby, and we need you.
We started, W-2s came out last weekend. Stuff started to hit, It always starts slow. It starts at the W-2s, then the 1099s. Then everybody's calling every 5 minutes wanting to know where the return is. So we're a little bit ahead this year. It's feeling pretty good.
And you have what's the name of your accounting practice?
Lear Pannepacker, CPA firm. We have offices in Princeton, New Jersey. I was there for 15, 16 years. Hamilton, New Jersey, and I run our Pennsylvania Bucks County office.
Okay, understood. How long you been an accountant for?
I'm in my 18th year of this. I've been with the firm since this firm literally took me right out of the kitchen.
Okay.
So kind of a little bit of backstory. The managing partner of our firm, he's been doing this for a little over 40 years. I always joke around, he's been doing debits, credits so long, since before the credit was around, it was just debits.
Right.
And I was actually a chef and kind of a pseudo business manager for one of his clients.
Okay.
And I went to accounting school and was kind of running the restaurant. And then Eric found me in the kitchen, literally.
No kidding.
At one of his clients. And just kind of worked itself out. When I was kind of done with the restaurant business, Eric hired me. I've been with the firm ever since.
That's great. That's a great story. How you got into it? How'd you pick such a riveting career like taxes?
It kind of worked. It kind of worked by accident, I guess. Right.
Okay.
Working as a chef, I wanted to just go to straight up business school.
Right.
So in Philadelphia, I lived in Northeast Philly. Wasn't a lot of schools to pick from that I could afford or get into. Coming from with my reeling career out of high school. So
Sure.
I applied to a school that was right in our neighborhood called Holy Family.
Yeah.
I was going to go there for just basics of, get a BA. And as I got into it, I identified that I really liked the accounting classes for two specific reasons. They were real structured. I like structure because everything else in my life is not structured. So being in the classroom, I like the structure, and everything has a solid answer. It's not like a philosophical discussion on stuff.
Sure.
So that's how I ended up in accounting, worked in the restaurant business for years. And then it just kind of fell in that I started, doing the books at the end of the night. Then I started doing the books at the end of the month, and I'm doing the payroll, and then I'm doing the ordering. And It became that I was doing more debits and credits than I was flipping crab cakes at the time. So I ended up here. Yeah.
Hey, you're going to find a lot of our audience is self-employed, and then we also have some W-2 people as well. So I want to hit W-2 income really quick.
Sure.
How in the world do you get your tax liability down if you're paid on a W-2? Because it seems like it's impossible. I go through it with my accountant every year.
Yeah, and I tell everybody there's really no magic bullet on this. The most important thing is in your industry is to be maxing out your 401k, getting your pre-tax deductions in, participating in your 125 plan if you have flexible spending for medical or child care, maxing out the 401k. Absent that, there's really not much else you could do. Tax Cuts and Job Act eliminated the unreimbursed employee business expenses.
Yeah.
So really not much you could do at the federal level, depending on what state you live in. Sometimes you could take those, like in Pennsylvania you can. But there's really not much you could do, unfortunately, at the W-2 level. Working with your employer and kind of getting creative on where the deductions happen, right? If you're entertaining clients, you're bringing them out, making sure that's getting reimbursed dollar for dollar is really the best way to do it.
Now, you mentioned the 125 plan. Now, that's pre-tax money towards healthcare expenses?
It could be through a myriad of things. I think the original history of the 125 plan, they call them cafeteria plans. So if you do a quick Google search, if you Google 125 plans, probably a bunch of stuff comes up that's non-tax. But usually if you want to take a look at that, you would Google section 125 cafeteria plans. I think the original part of that tax code started where it was if you would put pre-tax money away for actually buying lunch or your meals while you worked where you worked.
Okay.
And inside of those 125 plans, you could designate money for healthcare. I've seen people doing it for childcare. Really, a lot of expenses. You can get pretty flexible, right? It's like a flexible spending.
Now, what do you set
account.
up a separate account, or does it have to be through the employer?
Usually, the employer sets it up, and it has to be what I think is called like an employer-sponsored plan.
Yeah.
And then I've seen them for travel reimbursements. More often than not, the 125 plans are almost always medical.
Yeah, because they give you an option, right? An HSA plan, PPO plan, and then they tell you here's how much can come off your gross income, and that can go towards your deductible or different out-of-pocket costs that you have. But they limit it, right? It's not an unlimited amount.
It's limited. Every year it kind of changes. I know we just got a big bump this year coming in, and tax accountants always kind of work in the past. So I mean this year, right. I actually mean this year, 2023. Right. But I think don't quote me on this, but I think it's somewhere in the range of like $7,000 to $9,000 for a health savings account that you can put away pre-tax.
Yep.
Now there's some issues for your self-employed people, and a lot of people miss this up or mix it up when they're doing it. If you're self-employed, you're a Schedule C filer, and you want to take advantage of an HSA, health savings account, you have to be enrolled in a high deductible plan now.
Okay.
So for it to be deductible.
Interesting.
So,
okay.
Yeah, and it'll actually say, I always joke around with clients, well, how do I know if it's a high deductible plan? It actually says it on your card now. It'll say HSA applicable plan. So generally, you take the health savings account. What that does is it keeps your premiums down low, and then you have the higher dollar value out of pocket. So depending on where you are in your health,
makes sense.
In your age, you can put a little more money away.
Makes sense. Now, being a mortgage person by trade, I routinely have conversations with people looking to buy a house to give them. I never give advice. I'm not a CPA, but I try to lead them through experience down the path of what could potentially be tax deductible for you when you have a mortgage. So, if you could speak to that a little bit, Dennis, like what can you deduct? I buy a house. What's in it for me?
Yeah, it's been really tough. I mean, it's actually getting easier to identify what's deductible now.
Okay.
Given interest rates are coming up, which is pretty interesting, right? So for the last 10 years, people have been borrowing money, whether they realize it or not. They've been borrowing this money like underneath the inflationary index, and it's been like unbelievable.
Right.
So if you're a first-time home buyer, last 10, 15 years, and you're buying a house, depending on how much mortgage indebtedness you have, even if your mortgage rate, you have people with sub 3% mortgages across the country now. So your mortgage interest wasn't really a big deduction on your tax return. Tax Cuts and Job Act comes in, and it changes the way that the standard deductions and the itemized deductions work. So when you're looking at your first-time home buyer, for years it was always like, oh, your mortgage interest is tax deductible. Tax Cuts and Job Act comes in, and it created such a large standard deduction for taxpayers, like they're married filing joint,
like $24,000,
right?
Okay.
And if you're not paying, if your mortgage rate is 2.7% or even 3%, and your total mortgage indebtedness on your first-time home, if you're talking to a first-time home buyer, could be sub 3, even sub 2.
Right.
They're not paying enough interest to get above that hump, so it ends up being that they don't get the tax deductible interest expense on their mortgage.
Yeah. Now, good question for you on that. So do you automatically, if you're married filing jointly, get the $24,000 deduction?
Yeah, you get it. It changes year to year with inflation, but you get the standard deduction right out of the gate.
Got it.
And it's determined based upon your filing status. So single, head of household, and married filing joint.
Okay. So you have that option, or you could technically itemize deduct everything to see if you're over the $24,000 for married filing jointly. However, to your point, it's a great point. Rates were so low, people didn't pay $25,000 in interest last year, right? I think something like 86% of the country is at a rate at 4% or under, like some ridiculous number like that right now.
Yeah, and I think it's about that rate that are no longer itemizing for deductions at the moment too, because the standard deduction has gotten so high. And it's made tax preparation a little bit easier for the folks that are, self-preparing.
Sure.
Also in that Tax Cuts and Job Act was the SALT limit, where your state and local taxes got capped at $10,000. And $10,000 in New Jersey real estate taxes, you could hit that in a quarter. I live in Bucks County, so a little bit different in Pennsylvania, but in Jersey you're hitting it so quick that you're really not getting from your home, from a tax deductible standpoint, to finish that question off, you're really not getting a ton out of your interest at the historical rates we've had last 10 or 15 years, and you're capped at your real estate taxes.
And then they cap you at $750,000 for a mortgage loan amount, right?
Exactly right. That used to be $1.1 million.
Right.
Now it's $750. Yeah.
Hey, I just want to kind of take a little bit of a step back, and I want to talk about tax deduction and what it means, right? Because people throw the term around. You can be at a grocery store, people are throwing, hey, it's tax deductible, this. What does it really mean?
So the way I explain it, and I'm going to give you kind of a reference here. So a client called me 2 weeks ago, brand new client. They went out right over Christmas time, and they walked out of their old accounting firm in like October, November. Old accountant said, hey, your taxes are going to be $20,000 this year. You're going to owe it for your fourth quarter payment, which is January 15th.
Okay.
So something happens in that relationship. They walk out. They engage me. They tell me, hey, I just bought a car for $20,000. I don't owe any. I'm going to write this thing off. I'm not going to owe any tax.
Right.
And a lot of people kind of misconstrue, your tax deduction. Like this accountant told them their tax is going to be 20 G's. They went out and bought a car for $20,000, thinking that it was going to be a 1-for-1 match.
Yeah.
And that's not the way it works, right? So to kind of answer the question like I explained it to her is, depending on where your marginal tax bracket is, you're going to save like a percentage on the dollar of everything you do.
Right.
So I tell most of my clients who are self-employed, I just use the 35%. So if you're going to buy a $100,000 SUV, you're going to save $35,000 in tax on that bad boy at 35%. So that's the way I kind of look at things.
Okay, and you'll save it, just so everyone's clear, it's $35,000 in tax liability.
That would be mitigated by that large capital.
It's going to drop that adjusted gross income by $35,000.
It's going to drop the adjusted gross income by the full amount that you're buying the truck or the car for, or whatever you're buying, and
For self-employed,
right? For self-employed, it's going to drop it, and then that's going to give you the 35% tax savings on that reduction in taxable income.
And the other thing that it has impact is it could potentially put you into a lower tax bracket.
It can. Sometimes that happens. Most of the time it doesn't. It depends where your income is. And, if that's an opportunity that we have, sometimes we do work in that space, right? If a client calls us with enough time at the end of the tax year, and this could be something we're discussing like New Year's Eve. Yeah. Very common for me to be on the phone almost until that ball drops talking about, what they're doing. And they're still buying assets, trying to figure things out. And depending on where things go, we're actually kind of working it all the way down to the line there to try and figure out where the best tax saving is and when to buy it or what to do with it.
Now, the clients that you work with, do they reach out to you, if they're self-employed, they reach out to you quarterly to say, hey, listen, this is what I got going on. Here's my tax liability.
It's a little bit more than that. Okay. The way I sell my services, and I think where our firm is a little different than most, is I always say we're a minimum of 5 touches a year. And that includes your tax preparation. So that means if you meet with me for your tax prep, or we do a Zoom, or you're doing a drop-off, you want to talk to me at least 4 times during the year. We're better at giving you proactive tax advice than after the fact. Yeah. And a lot of people, don't want that. They just want the quarterly estimates, and they want to walk out the door and deal with me next year, which is cool. We do that, but that's not really where the value is in the relationship. It's meeting with everybody about 2 weeks before that tax liability payment's due for your quarterly, for the self-employed people, and kind of figuring out what's going on.
Okay. Yeah, we got to talk later, Dennis.
Yeah, sounds good, man. Let's do it.
So from a W-2 standpoint, they give you an option when you complete the W-4 form when you're working for a company. And that W-4 form is basically what are your dependents, your head of household, everything like that. So the advice that I had received at some point in time, having owed many, many, many times, was if you claim 0 on it, then they're going to take out the maximum amount of taxes, and you shouldn't have to owe necessarily at the end of the year. And I know I'm simplifying it, so I know it's more complicated than that.
Yeah, I mean, it's so the lower, if you file, for example, single 0, you're going to have the let me think about this. So if you walk in, they changed all these rules. The W-4 form used to be kind of this real easy form. And I think 2 years ago, they completely changed it.
It's like 10 questions on it.
It's gotten ridiculous. So it's funny you should mention it. Yeah. So here's what I tell clients when they call me, hey, Dan, I need my W-4 done. I'm changing employers. I say, listen, talk to HR and tell them you want 28% withheld on every paycheck, irregardless of bonuses, regular compensation, everything you want, 28%, and we're kind of good. Okay. So I tend to approach it that way. Most HR agencies will require you to fill out the W-4 form. Right. And the more dependents you put on there, the less withholding you'll have. Right. So, I always kind of look at it that way. Now, there are tables and there's calculators all over the place. The IRS actually has a pretty good calculator, and it'll spit out the W-4 form completely filled out for you.
Oh, that's great advice for people.
Yeah.
If you go to the IRS, and it'll give you what you need to...
Exactly right. Yeah. So you can go to their website. You can pump it out. Any accountant can do them for you. I do them. Don't mind doing them, but usually it's as easy as calling the HR people and, or working with the HR representative. Say, hey, listen, I'm in the 25% tax bracket. I want everything withheld at 25% federal, 5% New Jersey, and I'm good.
Right. No, that's fantastic advice because I'm going to use myself as an example. I'm like an extremist. So originally, maybe I have 4 kids. I have a wife, 4 kids, had a household, and I'm claiming a bunch of dependents on it, and they were never taking enough taxes out. Yeah. So by the end of the year, it was like this big bill that I got from the IRS, and obviously you have to pay the bill. And I went the total extreme other way. It was like, okay, well, I'm just going to claim nobody, and then I get money back at the end of the year. But to me, there's got to be like a fine balance in there.
I always joke around. I say $1,500 one way or the other way is kind of the sweet spot for earners in our area here in Jersey, PA. So I try and work it that you're either going to owe them $1,500 or you're going to get $1,500 back, and you can test that throughout the year, right? Okay. And if you're working with your tax preparer, you want to be talking to that person a couple times a year to make sure this is good. Sure. So very often, what I'll do is if it's somebody just coming in with a W-2 earner, somebody that's in your industry, I might say, hey, listen. Right around June, I'm going to throw something on the calendar. I'm going to ask you to send me your most recent pay stub. It's kind of an automatic reminder, hits
Great.
both of us. We take a look at it. We do a quick analysis I just do a percentage analysis, see where it's at, and then I can modify it as I need it from there. So usually you want to take a look at that at least once a year to prevent, you don't want to give the IRS. Well, some people like doing that. I don't like it. Some people like using it as kind of a forced savings vehicle, and they use that as their vacation money or whatever they want to do with it.
I kind of low-key hate it, right? Because I feel like you've been holding my money all year.
Oh, I don't like giving them any money.
Yeah,
I don't like giving them money earlier than I need to.
I feel like now I got to wait for you. So I paid all this, now I got to wait for you, and I routinely file late in the year. So,
and if the later you file in a year, sometimes the IRS, like you saw in the last couple of years, got overwhelmed with backlog, and then you end up waiting for your tax money back. And I just never like clients in that position where you're waiting. Sometimes it's possible for clients to be waiting 30 to 90 days for their tax refund. And if they need that money for survival, it becomes like a problem, and I feel bad for them. So take a look at it at least once a year or something, I recommend.
Now, do you recommend people to try to get their taxes done as quickly as possible before the 15th deadline?
Before April?
Yeah, before April 15th.
It's almost impossible to do that today.
Yeah.
Unless it's just a W-2 earner, right? Like we have people that are just W-2 earners. We've been pumping those returns out all week, and we started doing them, I'm going to guess, for like the third week of January this year, maybe a little bit earlier. For those people, absolutely, as early as possible. The problem becomes is if you have any sort of investments today with any broker-dealer and you're waiting for a 1099, often what happens is those 1099s come in around mid-February.
Right.
Often they come in with a disclaimer on them basically saying, hey, there's international exposure here. And there's international exposure in all these mutual funds and ETFs today. It's almost impossible to avoid any sort of international exposure with like an asset-based allocation in a mutual fund for these asset-based funds. And what'll happen is we get a disclaimer on the 1099 that basically says this may or may not be amended in the future for qualifying and ordinary dividends. So what I often see, and I tell my clients, is if I see that disclaimer on there, I tell the client, hey, we have everything. We're going to draft the return in February. Going to wait until March 15th because that's when they're going to do a secondary review in these 1099s. And I'd say 85 to 90% of the time, these 1099s are being amended. So if we rush to get that return out, we may have to amend that thing. And I don't want to have my clients pay for
that's actually a really great point. You kind of break that down for everyone so they understand it. So if someone's receiving a 1099 from investments, that means basically you're getting some type of dividend, capital gain, something like that. You get that 1099 form. And if there's international money associated with that, that 1099 could change.
It can change, and it can change in a multitude of ways.
Yeah.
A capital gain can be recategorized as ordinary income or a regular dividend.
Yeah.
An ordinary dividend, which is taxed at ordinary rates, may not be classified as a qualifying dividend, and obviously qualifying dividends are like the prettiest picture. That's what we want to see.
Right.
Those are taxed at reduced rates. So, depending on how complex the reporting is inside of whatever the investment vehicle is inside the broker-dealer, it can indicate that we're going to be kind of pumping the brakes on these tax filings. And that's what I tend to do is prep them and then hold them until that secondary release of the 1099s comes out.
Yeah, this is why it's so important to speak to a professional about it so you understand the different nuances of the field, the industry. How do you feel from a tax benefit standpoint about vacation homes or investment properties?
So it depends on it depends on a multitude of things, right? From just strictly a tax perspective.
Yes.
All right. Strictly a tax perspective, a vacation home is not really going to get you much as far of in the way of tax deductions, especially if you're using it for personal purposes.
Right.
Obviously, I think you get 2 weeks now. It's either 10 days or 2 weeks. You can rent it a year and you don't have to disclose it to the IRS.
Right.
Outside of that, there's really not going to be much of a tax benefit. If you're a W-2 earner and you're earning over $150,000, any deductions you have on that's going to get held and it's not going to be deductible.
Now, if it's a vacation home, does the tax deductibility of the interest, does that get added to the primary residence as well? Like, is it one lump sum?
Yeah, if it's a vacation home, it's your secondary residence, so you're still at that 750 Gs.
That makes
and
sense.
You're not going to be able to deduct it. Yeah, I mean, so I always tell clients, when you're looking at buying a vacation home, talk to your investment advisor and make sure this makes sense in your global asset allocation because you're putting a ton in real estate. Everybody, I'm from Philly. Everybody wants to buy a house in Wildwood. Does a Wildwood purchase really work with your asset? If you're in your 40s and you're going to be retiring in the next 20 years, do you want, $350,000 condo in your kind of investment pool? Are you pulling that out of your 401k contributions to satisfy those mortgage payments? That's what I tell people all the time.
Yeah, makes sense. Now, how about from an investment property standpoint?
So investment properties are a totally different ballgame. So there's kind of two roads and two paths with investment properties. You've got your real estate professionals kind of on the left here, and that's probably like 10% of my clients, and then your W-2 earners who have full-time jobs that buy investment properties, and that's like that 90% pool that's here on the right. The people that are in that pool can take advantage of of a rental property and holding it, especially if it's obviously a commercial based rental that has high yield. You can take depreciation against it, and that depreciation, which is a non-cash expense, can be a really nice preventative measure for paying income taxes on the gross rents you're receiving. So from an investment property standpoint, depending on what type of investment yield you're getting from this, it can be very helpful.
And I'll just throw out there from a mortgage standpoint, when you look at depreciation on an investment property, people are itemizing a lot of deductions on investment property and probably not showing that much of a profit on it. So if they need any income to qualify for a mortgage that they're doing, you can actually add depreciation back in as income, and you can use that because it's really just a paper loss on it.
Yeah, and I actually call that out on the tax returns. I'll actually put in the letter, add back depreciation for rental property X as $23,000. This way it prevents guys like you calling me up at 10 o'clock at night going, where's the depreciation? I can't find it. I call it out there because it's a major add back. And as you know, in your industry, the easier that is to call out, the better. Now, that's funny you bring that up because often people self-prepare their returns, right?
Yeah.
And they'll do let's say they have a rental property, in Philly, we've kind of got the, we got the residential property on top, and you've got the, commercial property on the bottom. I think we call that like Walt Whitman zoning or something in Philadelphia. I forget exactly what they call it. But you got a property. It's got like two different types of yields in it. You got, big depreciation numbers. Let's say your tenant leaves. It's COVID. You don't have anybody in there. You spend $35,000 rehabbing the place, right? Very common. I see a lot of people self-preparing. They'll prepare to return repairs and maintenance, $25,000.
Right.
They go to get a mortgage and they can't add that back.
Right.
So working with the taxpayer who understands what needs to be capitalized and what can be written off is really critical.
Yeah, no, it makes sense. I mean, this time of year from a mortgage standpoint, I talk to a lot of self-employed people, and I get really good relationships with their accountant, so we can understand exactly what's going on if their plan is to buy a house in the upcoming year, whether or not it's investment, second home, or primary residence. From an investment property standpoint, do you think it's beneficial? Well, more beneficial one way or the other to be reporting it on a Schedule E, or should people be in an LLC? Is there any tax advantage?
So it's a great question, great topic, man. I love talking about this. So putting it inside of, all the rental properties are going to show up on a Schedule E, regardless if you own it personally or if it's a single member LLC.
Okay.
So if it's a single member LLC, it's actually called a disregarded entity for tax purposes.
Okay.
In essence, it doesn't have any effect on the filing. So if I own a rental property and I own it, me and my wife, and we're filing a Schedule E, if we have that thing in an LLC we own, it's going to show up. If it's a single member LLC that I own, it's going to show up on that Schedule E. The tax deduction is going to be exactly the same.
Yeah.
If we take that thing and now we make it, a double member LLC, and it's inside of a 1065 filer, it's going to be off of your tax return to a point. It's still a pass-through entity, but it's going to actually it's going to, in our opinion, I think I'm confident to say this about our firm. If you put it inside of a double member LLC, it's kind of removing it from your tax return. Yeah. And in my opinion, it reduces your overall audit risk on that because it's consolidating it up. It also gives you kind of the opportunity to have all of your LLCs kind of inside of one holding company, so or all of your rental properties inside of one holding company. So from a tax deductibility standpoint, if you're still in that 90% and it's an investment person, not going to be a major tax savings. It's going to continue to add legal liability, which is what you want, obviously, if somebody gets hurt in a property. Right. And in our opinion, it makes it easier if you want to go to sell it, if you want to sell membership units of the LLC instead of retitling the property and things like that.
Yeah, that makes perfect sense. Now, if it's a multiple member LLC and you're filing on a 1065, can it be husband and wife if you're filing a joint personal return?
Yeah, so if you have a husband and wife who open an LLC together, they can file their own 1065, 50-50 or however the ownership is, and then that becomes a pass-through entity, and they receive a K-1 on the net rental income or expense or loss that's left on that thing.
That's fantastic. You know a lot.
Yeah, it's exciting stuff. This is what I like to talk about in the afternoon in Jersey.
I grew up in South Boston area. You'd be wicked smart. Nice. I won't hold it against you that you like Philadelphia.
Hey, it's all right. From the town, I kind of can't get that out of my blood. It's in my veins, so it is what it is.
So we're going to take a quick break. It's Greg Wareham again, Dennis Kilfeather. We'll be back in a few minutes. Stay tuned tuned for this, though, because we're going to really start to get into the self-employed income, talk about real estate agents and different types of businesses. So we'll be right back at you. Hello, everybody. Welcome back to Your Mortgage Process. I'm Greg Wareham. We have Dennis Kilfeather today, expert in accounting. So we're talking a little bit off air about the fine line between accounting and financial planning, because there's a I don't say gray area, but they're connected.
Yeah, they're definitely connected. Our firm has never really done what I would call asset management. We do financial planning. A lot of firms out there prepare your tax returns. You sit down with them, and then they're trying to sell you life insurance or an annuity. And I always question myself, is that an accounting firm? Are they a tax preparation firm, or are they kind of an investment advisory firm, kind of masquerading in the tax space?
Right.
And in some instances, I'm sure that works for some guys. You're a self-employed individual. You meet with your accountant. He also helps you fund your IRA. It's a one-stop shop. But I just, in my opinion, at our firm, I think we do what we do well, right? We're your tax advisors, and we're kind of guiding that ship and helping you kind of identify, what's ahead of you on that tax journey. And while we can absolutely help with financial planning, and we do financial plans for people, more often than not, what we like to do is work with the investment advisor and kind of create that, I call it that triangle approach, where you have the client at the top, the financial advisor on the left, and the tax accountant on the right, and in the middle somewhere is like an estate planning or attorney or somebody in the middle, and kind of going back and forth and helping with that.
I'm going to insert mortgage person into that circle.
I'm sorry. Absolutely.
We're going to go to a square.
Yeah. All right, let's do it. Let's do it. Absolutely. Sorry, I cut you out of there. Yeah.
Right. So I want to talk about self-employed people. A lot of our listeners are self-employed. And when you're self-employed, you have a few different options as to how you're setting up your company, right? You could be a sole proprietor, subchapter S Corp, C Corp, LLC. What do you think? What are the pros and what are the cons? Could you talk a little bit about that, Dennis?
Yeah, I could talk about it all day, baby. So my favorite thing to talk about with this is to do the LLC, right? If you're able to be self-employed, depending on how your agreement is with the mother organization, like you're in correspondent lending. Sometimes you can't do it. If you can, you're going to open up your own shop. I had a guy come in 3 weeks ago, opening up an electrical contracting business. He walks in my door, says, "Dan, I'm opening up an electrical contracting business. I got my insurance. I got my license with Pennsylvania. I'm ready to go. What kind of an entity do I want to set up?" Hands down, I want to do an LLC right out the gate.
Right.
The reason I like the LLC so much is it's really dynamic. It's easy to form. It's cheap. Gives great liability protection if you use it right. But the biggest thing is, to go back to your kind of that first question you posed, what type of an entity? An LLC can elect tax treatment across the board. It can elect to be tax treated as an S corporation, C corporation, partnership. So it's really dynamic. And then it can change down the line. Every 5 years, if you wanted to do that, you can change your tax treatment of the LLC itself. So more often than not, clients come in, we're setting them up, a single member LLC, and then we're determining what we want to do with it from there.
Interesting. So why would someone then opt to go with, say, a subchapter S Corp?
So subchapter S Corps are, it depends on what they're doing and how their income is coming in.
Okay.
So subchapter S, let's just kind of go back a minute. So when you form an LLC, if it's taxed as a sole proprietorship, meaning it's a disregarded entity, it's kind of subject to 3 types of tax. You've got self-employment tax, which is a portion of your federal and federal income tax. Together, you'll file that with your 1040. And then it's got your state income tax filing, which is your third one. So you're going to have 3 taxes associated with a sole proprietorship or a single member LLC, which is a disregarded entity tax that way. Mm-hmm. The S corporation is not subject to self-employment tax. So if you go back to that triad, self-employment tax, federal income tax, state income tax, your S corporation is only going to have federal income tax and state income tax. Mm-hmm. So you can save a little bit there on self-employment tax, but if you take a subchapter S and it has earnings, you have to take a salary that's reasonable in the circumstances per the IRS code, and you'll have to pay payroll taxes at the employer and the employee level. And when you do that, that's essentially equivalent to your self-employment tax. So the issue is making sure you're working with your tax preparer and identifying the salary that's reasonable in the circumstances. And once you do that and you set that and you're comfortable with it, any other income from that S corporation that falls to your tax return via your K-1 is not going to be subject to self-employment tax.
That's a fantastic point. So when you're paying yourself that salary, then you're technically got to pay yourself on a W-2.
You do.
And now you're subject to the payroll taxes and everything else that goes along with that.
You do. But also, you can set yourself up with a 401k. You can do a unit K, solo 401k. So if, let's say, you're cutting yourself a salary of $100,000, you're going to defer you could defer to, let's just say in just ease of math, you're going to defer 20 grand into your 401k. On your tax return, you're only paying tax on 80 G's right out of the gates. You're already getting a huge tax deduction. So kind of doing the sub S corporation, working with an investment advisor, setting up a single member LLC or a UniK, or it could be a multiple member LLC. And then there's also things you could do inside of the 401k. It's just unbelievable dynamic tool. I get so excited about this, right? Is inside of the 401k, you've got like safe harbor 401ks. You can do employee matches, employer matches. You can do cash balance plan, bolt-ons, which are like defined benefit pensions inside of these 401ks. And you're sole proprietor, you're electrical contractor. This guy who came into my office, we're going to do all this for him in 2023.
That's fantastic. So you can maximize your tax deductibility of money.
Absolutely.
In that. Yeah, that's great.
And you drive the ship with being self-employed, right? So, if I want to do my 401k now and I'm a W-2 earner, I got to do my 401k week to week. You know what I mean? It has to come out now. Right. Whereas if you're going to be self-employed person and you're doing a self-employed pension, a SEP or a simple, you have until you file that tax return to fund your IRA. So you can kind of use next year's cash flow to take advantage of a tax deduction from the prior year.
Right.
So it's really kind of a leveraged opportunity there for being self-employed versus the W-2.
So now when you look at things from a SEP IRA standpoint, what I've noticed from my wife's self-employed, and the accountant tells us but when we file our taxes, what her maximum contribution could be. And I never understood it, right? I'm like, well, why can't you just, because I know the tax code is going to allow for X amount, but you can't necessarily maximize it.
You can't. So in those instances, a SEP is a very simple tool, right?
Yep.
The IRS indicates that you can put away 25% of your self-employed earnings into a SEP, and it kind of stops there. That's why I'm not a huge fan of SEPs, because they're a little bit, they hinder your ability to put more away in retirement and take advantage of your tax savings. That's why I'm a huge fan of doing a UniK or a solo 401k or something like that.
And to do that, you have to have a subchapter S corp. To do those things?
No, to do a UniK, you don't need to be a subchapter S. You can be taxed as a sole proprietorship. You just need to work with an investment advisor to create a 401k plan.
Right.
And then you could do, you could be you can have a solo 401k inside of a single member LLC, taxed as a C corporation, doing, a 401k with a profit share. And a defined benefit cash balance plan right on top of it to get the maximum tax savings.
Now, on the SEP IRA, can you, like, if you just use gross receipts, right, as $100,000, but you can't use 25% of that and put it into the SEP IRA. It seems like there's some other calculations that go into play.
A lot of other calculations. So if your gross receipts are 100 G's and you have, $75,000 in expenses, you're now stuck with $25,000 in net income.
I see.
So it's the amount that you could put away into your SEP is going to be a calculation based on the $25,000 net income of the Schedule C.
All right, that makes perfect sense.
With other limitations. So
that's why it sounds so good that you got to talk to you, right, to understand what your other options are, potentially.
Now, in that same circumstance, maybe selecting either a simple IRA or a 401k can allow you to get more put in.
Right.
So again, it depends on, who you're sitting with, when you're doing your taxes. You don't just drop your stuff off for me to take a look at your returns. We're going to optimize what the best opportunity is for you to put it away. And most tax practitioners never look at a simple.
Right.
And that's a different type of an IRA. So, and that often you could put a little bit more money away. So taking a look at the myriad of options when you're in that process is really important. That's why I tell clients, you got to talk to me 4 times a year so I see what's going on.
I love this guy, Nick. You know your stuff, Dennis.
Thanks.
Great to have you on the show. So, all right, so I'm self-employed. I'm going to use a real estate agent as an example.
Okay.
Like, what can you deduct?
So real estate agents are,
and I know you work with a lot of real estate,
and they're
agents.
some of my favorite clients, man, and they're also some of some of our more frustrating clients. Realtors tend to be like alphas; they're just on the move. They just want to knock, block, tackle, and go. Right. So you take that person; they're unbelievable at closing deals. I've seen some of the best business negotiators as realtors in my life, and it's just unbelievable. That type of person doesn't like to be in the nitty gritty of details, so they don't like to track their income and the expenses.
Right.
So for realtors, what I often say is if that's the person you are, what we try and do is isolate all of your banking activity for the real estate activities to one account. We set something up like QuickBooks Online, and everything that goes through that, we know we can track nice and easy to track your expenses. Now, the expenses for that realtor can be a myriad of things. It could be obviously the basic stuff, your MLS fees, your dues, your subscriptions. If you have desk fees, most of it can be your travel back and forth. And another thing realtors don't do a great job of is tracking their mileage, right? It's kind of a pain. Not everybody likes to track their mileage on a daily basis. You get a software suite like Mileage IQ, or even QuickBooks Self-Employed has a mileage tracker in there, and you identify what was a business travel and what was personal, and it does the allocations, and it sends these beautiful reports for me to calculate what your tax deductible items are. So realtors can have, office expenses, they can have cars, depending on what their relationship is with the broker. Again, they can have desk fees. Sometimes they can do business use at home. If they're not associated with a branch and they're not actually paying a desk fee and they don't have an office and they're working out of their house, they can do business use at home there.
That's great. That's great for people to know that. Now, do you suggest that they set up a separate business account? Or can it just be a personal?
It could be a personal account. I just try and isolate it because it becomes difficult for people that are, again, that person I described, the block tacklers out there making deals. They're not really going to be, in my opinion, they're not great at kind of identifying, all right, I'm going to spend, my marketing is going to come off this Amex card or this. They have like an Amex card, a Visa. They got their personal bank accounts, debit cards. They go away. They're taking clients out. They're getting gas on one card. It's a myriad. It's a mess to try and track. So what I try and do is just be as diligent as possible. Put this thing in one account and a credit card, but let us track it. And only do your business stuff in there. Yeah. So the income comes into that account and your expenses come out. And when you want to take money out, just distribute it to your personal accounts. It makes it way easier to track. And the big issue is, these blockers and tacklers, they move so fast. I worry that we lose deductions because we don't capture it.
Yes.
That's the frustration, right? When I say sometimes these are some of my most frustrating clients is they come in and they have nothing but their 1099 that they got from the broker dealer.
Yeah, no, I can completely see that just from personal experience. When you're Alpha, you're driving everything. I know that you miss deductions.
Oh, yeah, it's day and night.
Because it's almost like you don't have time to track it, even though you should have the time to track everything. I love your idea about setting up a separate account. I mean, one thing I would throw out there in reference to setting up a business account versus a personal account, well, now because you're self-employed, if you're paying something like your car payment through there and you got 12 months proof that the business is paying for your car, you don't have to count against their debt to income ratio when they look to buy a house.
Oh, that's why it's beautiful to have somebody like you look at this. It's not just depreciation. Look at that. It just found another ad.
Yeah, it's in the personal account. It's terrible. You can't track it. Fannie Mae doesn't like it. But business account, super clear on it.
What else could be in there?
Even credit cards. So if your credit card bills are being paid out of that business account for a 12-month time frame, you can ignore that debt from them as well.
Wow, that's unbelievable.
Yeah, so it's really credit cards and car payments.
So isolating the accounts actually helps with the debt service coverage ratio?
It does. And the key is business account.
Awesome.
Because Fannie Mae's real specific with it's got to be a business account.
Awesome. You just taught me something. That's great, Greg. Thanks for telling me that, man. I'll tell everybody, make sure it's in a business account.
Yeah, my pleasure. Have them call me.
All right, no problem.
So what else do you think we need to know, Dennis?
About us or taxes in general?
Let's start with taxes in general, then all about you.
So taxes in general right now, I think a hot item that everybody seems to kind of want information on are, if you have an investment property and you're trying to take advantage of depreciation is, I get these calls a lot now, are what are called cost segregation studies.
Okay.
And there are engineering firms out there that you can hire to come in and take a look at your property. And they basically look around, like I look around at this room, and inside of this, a commercial building, 39 and a half years is how you depreciate it. So if you buy the building, we divide it by 39 and a half years. But the issue is if you have a cost segregation study, well, these ceiling tiles are probably 7-year assets and they cost X. So if we bought this property for $1 million, we bring a cost segregation study team in, and what they do is they take that $1 million and they basically put it into pie slices for us. And they basically tell the accountants that, okay, this is the portion of the $1 million asset you bought that we can deduct in 7 years. Here's the amount that we can do in 10, 15, and here's your 39 and a half year bucket. And what you want to do is, in a perfect environment, is that 39 and a half year bucket goes down and the quicker depreciation ones go up, and that allows you to take advantage of depreciation in earlier years of holding the asset and getting the actual non-cash expense deduction each year.
That's great advice. And that was on commercial properties, correct?
It could be on commercial or it could be residential. It could be on both.
Because there's different ways that you can depreciate it, to your point.
Right. Residential is 27 and a half years.
Okay.
So, I do have clients that have a multitude of properties inside of, they buy LLC, they open up LLCs and they start acquiring properties. In Philadelphia, you have a lot of people doing that. It's very common for somebody to have 5 or 6 rental properties inside of one LLC. And yes, you can have a cost segregation study come in on each individual property to identify, okay, this is HVAC, this is electrical. And the engineers give you a report and it indicates the IRS deductible portion for those assets inside of the asset you got. So it's really cool.
I mean, it seems critical that you should really have that done because the cost is going to pay for itself.
It often pays for itself almost immediately.
Right.
And what's really nice about these, they've gotten so good at doing these. They tell you the cost and when you're going to get your benefit, and it's almost like month 6. It happens really quick.
So I have a question for you on a single-family residential property that you're selling. Say that you purchased a property 10 years ago for $400,000.
Okay.
And, since that to now you owe about $250,000 on it, right?
Okay.
Now, during that time, you sunk a lot of money into that house. Now, that money was all accounted for each tax year, I take it?
It should be.
Deductions? Okay.
Yeah. You should be talking to your guy like me and say, hey, Den, I put a roof on for 25 G's, and that gets added to your basis at that 400.
Okay. So then when you sell it, now you have a $150,000 capital gain, no matter how you look at it, right?
Well, if we didn't depreciate the full amount of that roof.
Okay.
And I mean, so we bought the property for 400 in your example, and we sold it for
$250.
We sold it for $250, so we're taking a loss.
Oh, I'm sorry. I apologize.
Okay.
No, I apologize. You're selling it for $550.
All right, so we're selling it for $550 that we bought for $400. We
Yes.
got $150,000 loss. If in that time period I put a roof on for $25,000, that $25,000 comes off the capital gain.
Mm-hmm.
Now, you'll place your roof in service. They're 20, what's a roof? 20, 30-year assets.
Right.
So that'll be divisible by 27.5. But let's say in year 4, I put the roof on for $25,000 and I sold it in year 5.
Right.
That $25,000 is going to come off your capital gain of $150 in that example.
Now, so would your capital gain in that example be the difference between what you're selling it for and what you owe on it?
No, absolutely not. And
Okay.
This is something that always comes up. So, in accountants, we're historians. That's all we really care about is history. So the way I explain this is, you buy the property for $400,000. Anything you do to that property, repairs and maintenance, we're deducting year in year. Any capital improvement gets put into it. So in this example, you bought the property for $400,000. You hold it for 10 years. You put $100,000 improvements on it. And over 10 years, that's very common. It's $10,000 a year. You do a bathroom today, it's 25 G's.
Sure.
So now you've got your property, it's $500,000. You're going to sell that thing for $750,000. Your capital gain calculation starts at the sale price of $750,000 and that historical cost basis. That's why I joke around. Accountants are historians.
Yeah.
So you take that $750,000, you back out the $500,000, which is your cost basis in the property. Then we take off the selling expenses, your realtor fees, and everything like that comes off.
All right. Makes sense.
Yep.
Makes sense.
Yep.
Again, you're a great guy to talk to about that. If you
Thanks,
have
man.
investment properties out there, what the opportunities are with investment properties, what do you do with them, right? The single entity LLC, how you're structuring everything. It's critical.
The opportunity zone is just unbelievable. And
Yeah.
for guys in your industry, to be able to take advantage of these interest rates, which are, I kind of have this conversation. I bought my first house in 2005. I think my interest rate was almost 9%. 2005 might seem like a long time ago to some people, but for me, it doesn't seem like that long.
It wasn't
ago.
that long ago.
I know.
It was like yesterday.
And interest, exactly right. Yeah, especially when you have 4 kids like you, you're keeping real busy. It feels literally like yesterday. So, I mean, these interest rates are not that high still.
Right.
They're still at historical lows, and everybody, in the media, everybody kind of gets all upset about it. Oh, the 30-year rate's up to 7%, and I'm of the opinion that's all still good, and it's really great money depending on where it is, And what I try and look at in these qualifying opportunity zones is, taking a look at where the rates are, and in the qualifying opportunity zones, because you're going to position that for tax-deferred gain and tax-deferred growth, build an 8% interest rate into not paying income taxes on a property that you hold for 10 years in a qualifying opportunity zone. And it's like a non-issue.
Right.
So often you need to kind of take a look, when I say you, I mean, the person who's buying the property, identify kind of what's going on and don't get all hyped up on, oh my God, a year ago interest rates were 3.5 and now I'm paying 7.25. Well, what are you doing with that money and what kind of yield are you getting with it? To kind of look at the overall objective here. And you said the qualified opportunity zone. With the QOZ, where you may not be paying federal income tax on a long-term capital gain that you hold for 10 years,
right?
What does an interest rate of 7%
it doesn't matter. It doesn't matter.
Because you're looking at your total, return on yield over that thing. And if you're not paying, 15 to 25% in long-term capital gains rates, to me, it kind of all comes out at the end.
That's a great point. I mean, because you're going to get the deductibility of all of that interest and everything like that. It makes perfect sense.
Now, are you seeing a lot of commercial lending right now? Or are you seeing mostly residential?
Yeah, not that much. Mostly residential.
Yeah. And what are we looking at? Are we looking at on the residential side, where rates today?
They've come down a little bit. So they peaked at close to 8% if you go back a few months ago.
Okay.
So we're now 10 consecutive weeks of being under 7%. They're right around 6.5%, depending on down payment, depending on exact credit score. But I mean, if to really optimize that zone on it, Dennis, if on a conventional conforming residential loan, if you have a 740 credit score with 40% down, that's going to give you the best interest rate. But now you're looking at something where you may be able to even crack into the high fives on it.
I mean, that's unbelievable, and that's still really low money. Cost of capital for that's great. Now, your ability to be able to deduct that interest grows because your mortgage indebtedness now is most likely higher than it was before.
Right.
So if you're at 5.25% on a 30-year primary residence and you're deducting $20,000 in interest at your marginal tax rate at 35%, if you do that math and kind of figure it out on the fly, your realized interest rate affected after taxes is probably 4.25%, which is unbelievably free money. I mean, you can get a CD today for almost 5%.
Yeah, that's a great
So that
point.
means you're borrowing money underneath the savings rate, and that's where you develop long-term growth, and that's how you build wealth, right?
Yeah.
And that's the problem I think a lot of people miss is how do I build the wealth over long term? It's like you got to take advantage of borrowing the money and getting the yield you need from it.
And along those lines, is from a consumer standpoint, understanding that it's complicated. Like behind the scenes, what the real value is of something, it's complicated. You got to know, to your point about interest rate on a house, and you have to understand the tax deductibility. You have to understand the whole picture in order to make a really educated decision on it.
Yeah, and then people are meeting with you to try and figure this out, right? Are you doing a lot of first-time home buyers, or is it?
We've seen a lot of it in the marketplace. It's really shifted. A lot of the first-time home buyers, Dennis, they were, I don't like to say priced out of the market, they were termed out of the market. Because if your average first-time home buyer is putting down 10%, the market we just came out of that's now shifted, well, there were other people that were step-up buyers that were putting down 40%.
Or they're paying cash, right?
Yeah, or they're paying a lot of cash. I don't know where all this cash came from. But there's a lot of cash out there. So it's more first-time home buyers, and it really has the biggest pent-up demand. When you look at the demographic of millennials, you're in your 30s right now, and you're the biggest population group of all time, bigger than the baby boomers. And the percentage of home ownership just isn't that high.
Yeah.
So before we went into COVID, in the shutdown, 42% of the market was first-time home buyers. And we haven't recovered from that yet.
Yeah.
And they didn't go away. It's just a question of coming back into the marketplace. So we're slowly starting to see that tick back into the marketplace. But until this inventory issue kind of gets a little bit more stabilized, where more houses come into the market, Dennis, it's going to be a challenge.
And when you're meeting with whether it's a first-time home buyer or a step-up buyer, are you kind of reviewing like the ARMs? Are you looking at 20s, 10s? Or are you kind of just focusing on 30s? How when you're sitting there trying to help them make the informed decision, what are you going over?
I've always looked at my job as I'm an educator, right? And I give people all of the options that are potentially available to them with the pros and the cons associated with it. So we've done over the past few years, been a lot of 30-year fix because interest rates were so low. But now you start looking at things, 15-year fix is an ARM product appropriate as well. 7-year or 10-year ARM. I don't love the 5-year ARM. 5 years goes in a blink of an eye. But at least 7 or 10 years where they're fixed for that time frame, it can have value for someone, especially if they're looking to sell the house. It's not their long-term house or investment.
Something I run into all the time is people call me and say, hey, I want to buy a rental property. What kind of mortgage can I do with that if I want to put it into an LLC? Do you ever run into that where, can a traditional mortgage go into an LLC?
That's a good question. So at closing, no.
Okay.
Can it go in after closing? Yes.
Okay.
And it depends on the investor behind the scenes. Like Fannie Mae allows for it, for it to get transferred into the name of the LLC. But depending on where that loan's going behind the scenes can dictate whether or not you can transfer it over into the LLC. Now, if you try to close on a loan in the name of the LLC, right, where now the mortgage is actually in the LLC and not in the individual's name, that's more of a non-conforming type of mortgage, and your interest rates are higher on it.
Are they still 30-year locks, or are they?
Yeah, you still do a 30-year mortgage, just higher rate, higher cost on it.
Yeah.
That's what I see more than anything. It's really the points associated with doing something like that.
Yeah, to me, that's actually that's not a bad risk assessment to make. Does it make sense to open the LLC, 2 or 3 days before closing, throw it into an LLC?
Yeah.
For I don't know what the point spread is on that, but if it's nothing really major,
right,
does it kind of save you the headache of having this thing retitled if you want to move it through? Because
absolutely,
I often get the calls.
I mean, there's seller transfer tax that can be associated with that as well.
And then sometimes you look at the fine print of who ends up with that debt. If you transfer the mortgage to an LLC, it kind of puts you in technical default sometimes.
Yeah.
I've heard attorneys tell me that's a nightmare if it gets called out.
Yep.
So, working with you, that's interesting. So that's something you could take a look at on the way in. That's awesome.
Yeah, it can be, and it all comes down to the investor behind the scenes.
Nice.
So,
do you know who that's going to be when you're actually...
That's a good question. You do. When you lock that interest rate in, you really have a good idea as to who that investor is going to be. Fannie Mae, Freddie Mac.
Okay.
Of course, FHA is kind of a separate entity, so it's FHA right out of the gates. And just to be clear on it, doesn't necessarily have to do with who's servicing the loan.
Right.
It's more kind of who that investor is behind the scenes.
Right. And those FHA, all those products, the Fannie products, they end up in mutual funds. I always wonder where that money goes in the grand scheme of things.
I just know they make a lot of money.
Yeah, I know.
Fannie Mae made a lot of money in the past few years, and it's still technically, I think, a government-sponsored agency,
really?
Based on the bailout from the recession that we had.
Wow, yeah, it's amazing because and the mortgage processing bounces around, and a lot of people think, oh, my mortgage is now held by BOA or moved to Wells Fargo, and the underlying investor most likely hasn't changed, just the servicing agent.
Exactly, the servicer is where that's completely different. If it's a true jumbo loan,
mm-hmm.
The jumbo loan's not going to go to Fannie Mae. It's not going to go to Freddie Mac. It's going to go to whoever that bank is.
Okay.
So, as an example, if you closed a jumbo loan in the name of Chase, what Chase basically did, Dennis, is they said, we're going to give you the money.
Okay.
And now we're going to have the servicing rights, and we own the debt, and we're not selling the loan. Now, It doesn't mean everyone reserves the right to be able to sell a loan, but chances are they're going to keep that on their books.
Yeah, well, the beseeches them to do it because there's such value. And I joke, I'm on my third house. The only bill I look at every month on a routine basis since I've started buying houses is my mortgage. Everything else kind of goes on auto pay, and I don't look at it. But for some reason, I'm opening that paper document, and I refuse to go paperless for some reason on the mortgage. And there's value in that relationship with your mortgage bank, and it's very strange, but for some reason I'm always going to open that up.
Yeah, it's funny. I couldn't agree with you more. I do the same thing, and I look at it because I want to see principal balance.
I want to see principal balance, and it's really strange. I kind of feel not like emotionally attached to the loan, but I kind of feel like I have like a responsibility with whomever this bank is to make sure I pay it back, and it tends to be kind of where I'm going to do business. I don't know if that makes sense, right?
Okay,
because
absolutely,
they're in front of my face, so there's value there from the banking end. That's something you're looking at in that servicing model every single month, and there's tremendous value there.
Yeah, that's great perspective on that. Yeah, I couldn't agree with you more.
And it's about I think my parents' generation, they stuck with a brand for their life. You know what I mean? This is the brand they always use. And for banking, it's kind of strange. It's all the banks over the last 15 years. I don't know how long you've been in the industry. They're buying each other. They're kind of going back and forth so quick. There seems to be kind of such drastic moves from bank to bank. And hopefully we start to see things kind of slowing down. You get these longer term relationships with your bank. So that's who you go to. Like, you can go to the same person, work with you, as a correspondent. You got a lot of different vehicles to put people, but there's value in that soul relationship.
Yeah, and you've seen that change. The banks you haven't seen the mergers you were seeing before. I've been in the industry for 25 years. 2008, that's when you saw a lot of that activity going on, when everything started to decline.
I had hair like you in 2008. That's what that did to me. Yeah.
So, Dennis, if someone wanted to reach out to you because they needed tax advice or they want to talk to you about potentially being their accountant, what would be the best way to reach you?
The best way to do is to go to our website, lp-cpa.com, or give us a call, 609-452-2200. Again, we have offices in Princeton, New Jersey, Hamilton, New Jersey, and I run our Bucks County, Pennsylvania office in Newtown.
That's great. Could you give the website address one more time?
Sure. It's www.lp-cpa.com.
That's fantastic. Dennis, it was a pleasure having you on the show.
Right. Thanks for having me.
It was really great. I want to thank everybody out there for listening today. Look forward to catching up with you next week. Bye, guys. Thank you for tuning in to this week's edition of Your Mortgage Process, hosted by Greg Wareham, produced by Greg Wareham and Nick Pavis at The Social Rift, and executively produced by The Social Rift. Thank you again for tuning in, and we look forward to catching up with you next week.